Thank you. Look, we won't spend a lot of time on introductions. I'm sure the speakers are very well known. But Alex, we'll start with you. And can you outline for the audience the role of infrastructure at CBUS, how listed fits into this, and I guess the challenges that you face in building the portfolio?
Yeah, sure. I fear I might be a bit of an outlier on the panel and potentially in the room as well, because I come from a very strong private market background, actually the head of private markets for CBUS, which is property, infrastructure and PE. We do have REITs, we do have GLI in the portfolio, but specifically with infrastructure, we include it in the broader fund, both for growth purposes but as well as diversification. So on the diversification side, we're clearly looking for assets that have a lesser correlation with GDP and a lesser correlation with key financial markets as well, hence our preference for private market assets there. Also on the growth side, we tend to find that the listed GLI opportunities have less growth in them. You know, you get obviously a cheaper price on them, but that's because you're not having the control in them as well. So in looking to drive performance out of those assets, we tend to gravitate to those that are majority controlled within our consortium, whether that includes GPs or just LPs or a mixture of both. But we're really looking for the outperformance there that comes with the controlling interest. Having said that, we do have GLI in the portfolio. We have our GLI managed by ResCap at the moment. The purpose for having that in there is to really support our pure infrastructure products that we offer to our members. Those are 100% infrastructure assets, so instead of cash there, we're holding GLI there to supplement that.
And maybe just the challenges of the Your Future, Your Super regulation, and you've touched on performance, but yeah, that'd be great if you could elaborate.
Well, Your Future, Your Super certainly had a big ride for infrastructure, originally starting clearly as a listed index. That didn't suit the market very much, being predominantly private markets, and so it has changed now to the MSCI unfrozen one that's the median ranking rather than the volume weighted, or the value weighted I should say. So with that, it certainly doesn't exclude GLI from portfolios, but I think one thing that has changed in the sector is that it now has, in my opinion, been a bit of a change in the supply and demand of quality infrastructure assets. So going back prior to COVID, there was, even during COVID, enormous demand for quality infrastructure assets, but we're seeing a lot of new assets come onto the market. Huge demand for digital and data assets, huge demand for energy transition assets, and so I'm starting to see a bit more of an equilibrium in that. So not as many investors looking to top up their allocation and get to the Your Future, Your Super SAA with GLI.
Thank you. James, maybe we'll move to you, and can you outline the role that infrastructure plays at the Future Fund and how you think about it and go about?
Sure. So infrastructure plays a similar role probably to that which Alex described, in that it provides diversification, it provides cash flows that are generally resilient, a bit more stable than equities. It provides inflation pass-through. So I work in the listed tangibles team. The listed tangibles team is listed infrastructure and listed property. We sit within the private markets team, so our closest relatives are the unlisted infrastructure, unlisted property and private equity teams. And there's a separate global equities team which works in the public markets. The listed infrastructure portfolio gives us the capacity to be nimble and flexible in our exposures. So we're constantly weighing up valuations and where we see listed infrastructure being priced relative to unlisted. We work very closely with the unlisted infrastructure team in sharing information. So just prior to this, I was having a catch up with PG&E with one of our unlisted infrastructure team members from the Future Fund. And that plays a really important role, because having global listed mandates means that you can have discussions around many different assets around the globe in different geographies on a regular basis. And I think this helps inform the private side and the investing prospects.
Excellent. Maybe Ashwin will bring you into the conversation, and maybe how you think about blending listed and unlisted infrastructure. Obviously, IFM's done a bit of work on it. So
Yeah, so actually probably we outnumber James a little bit here, Alex, because I'm also primarily on the unlisted side. But look, it's an interesting question. So I guess the broader market is pretty well understood particularly in the Australian context, and we all like infrastructure more broadly because of the underlying inherent characteristics that the assets offer, whether it's unlisted or listed, which I think you had on your slide earlier, Dan, but particular characteristics that have been quite, I think, important over the last few years. When we've been speaking to a lot of our investors, both in Australia and globally, I think the view has been that there's a role for both parts of the market. Typically, we would look at it from a point of view of unlisted infrastructure forms a cornerstone part of an infrastructure portfolio, and then I guess the listed market gives you a way to, one, either drive liquidity outcomes or two, take particular tilts depending on your sort of broader views in the market. And that sort of conversation that we've had, I was recently in the States as well, where it's an interesting dynamic because the market's there still sort of learning about infrastructure as a standalone asset class, and at the core of all of it is what's the underlying assets that you're owning, whether you're owning them direct or via a listed manager, and then what does that drive, as the outcome for your portfolio overall. And so, whilst IFM is predominantly unlisted manager, we are working with our listed equities team as well to look at products that sort of incorporate our overall thinking around how we build the infrastructure portfolio and apply that across both listed and unlisted markets.
That's great. Obviously, when we look at long-term performance, showing very similar. So the question is, and there's always different answers for this, is are the assets the same? And let's just say Sydney Airport. Ashwin, do you want to start there?
Yeah, I mean, look, so the fundamental to owning infrastructure assets is understanding what are the value and risk drivers in each asset, right? So regardless of which side it's in, do you have a good understanding of what are going to be your value levers in the asset, and do you have an understanding of what are how the macro factors in the broader environment are going to flow through the asset? So from our perspective, obviously, I think Alex touched on this before, which is that our view is that from the unlisted perspective, we think that we can drive our performance through the control that we exert on those assets and our understanding of the sectors that those assets operate in. But ultimately, it comes back to the fundamentals of the underlying asset and your understanding of those and what they add to your portfolio.
Maybe just to build on that, the arbitrage between GLI investors and general equities or the marginal pricer, that's often the benefits of in investing in listed infrastructure. But I guess private investors can benefit too, because ultimately it's still broader equities that are marginal, that are the marginal pricer. So I guess, if you can talk through that control premium and how you think about it.
So I think we obviously track the listed market as a source of typically as a source of acquisitions rather than exits from our side. But having that detailed understanding of the assets and then being able to show what we think we can deliver on top of what the broader market thinks the asset is worth, and that premium comes through not just on your ability to influence the outcome, but your ability to really, have actual decision making power on as either sitting on the board or, in our case, often being able to second people into the assets and be able to drive outcomes that way. So I guess the control premium is a real thing for us. We think that the outperformance that we drive based on the influence is an actual value driver, and then therefore justifies the additional premium that you would expect from a controlling stake.
Excellent, thank you. I like this chart because it shows that everyone's a winner, which is great. Listed infrastructure companies or investors are benefiting, and in a lot of cases, unlisted infrastructure investors are able to capture assets at discount. So, maybe Alex, not every transaction is core, though. There's a lot of different strategies a lot of different things happening in unlisted infrastructure. So maybe, keen to get your view on the control premium, but then, what do you see that's not core in terms of how the assets are managed or the values brought out?
Yeah, so from my perspective, we're happy to participate in transactions, take privates where there's a premium for control paid, and also to give up the liquidity, as long as we have absolute conviction that the value can be recovered and exceeded, I should say, through active management and exit again of that asset. We tend to do that more with the closed-end managers because of their really active strategy. It doesn't always have to be a take private, it can be a JV or a carve-out of assets from listed entities. Where we don't tend to get involved is when obviously we don't have that conviction as to what the active management can bring, or we can't exit that position again. Particularly when you've got a closed-end vehicle there, so you're really dependent on what the market's going to be looking for at the end of that period. There's obviously been Sydney Airport and the attempted take private of Origin, both very different assets. My consideration is that Sydney Airport was bought very well, so there's value to be driven there. Origin didn't go ahead, so I'll probably stop commenting on that one.
Excellent. Look, I might bring it to James, and maybe you can talk about how you think about the definition of infrastructure, because I think that's really critical for listed, but there's also some different schools of thoughts in the room.
Yeah, look, for us, our definition's pretty simple. We pretty much stick to what we consider to be core infrastructure. So I don't have a long-winded answer for that.
Okay.
I can probably chip in as well. I mean, I think there's a lot of differing views in the market around where particularly that grey area, what is core versus core plus value add, and there's a whole host of views that people take. And at the risk of repeating myself, I mean, it's really about understanding the underlying fundamentals of the asset. There are parts of the market that might view certain transportation assets as not, or as towards the top end of core or core plus, and without fully understanding the underlying protections that you get via a concession agreement, for example. So I think it's that grey area really then comes back to looking at the underlying exposures and value drivers of the asset that you're investing in, without sort of taking a simplistic view of this sector is core or this sector is non-core. Obviously, there are some sectors in there that firmly fall into one or the other, but there's a large grey area, and it comes back to the individual asset.
I think just on top of that, certainly I agree. I love the massive expansion in the definition of infrastructure over the last decade, and the opportunities that brings for interesting investment, but also business strategies and management strategies on those assets as well. So it's something that CBUS has certainly embraced in putting together its portfolio. Private compared to public markets or GLI, typically GLI is a more core underlying infrastructure exposure. Having said that, you start to bring in developers and logistics, and these sorts of things are coming into the definition as well. But not seeing that a lot of the big telco assets and energy transitions and those types of things, which you still really look for in the unlisted market.
And just on I guess the different risk profiles. I mean, it seems like the unlisted market increases in the sort of sophistication of the strategies that they are rolling out, build to core, some quite complex carve-outs you see. So I don't know if you've got any thoughts on those sort of transactions.
Yes, we, as I was saying earlier, driving growth out of the infrastructure portfolio without the benefit of lower risk-free rates at this time is really about driving value from the assets and taking different risks that you consider that you can mitigate to achieve the right risk-adjusted return. And so, absolutely, in the greenfield space is a particular area for us. Again, going back to energy transition in particular, has been somewhere where we've liked to invest, but also transitional strategies. So taking parts of an incumbent telco and turning that into a new asset, adding 5G to it, those types of strategies, still the same underlying asset, but a new strategy put on top of it to drive the value.
Maybe just in terms of responsible investment, we can move on to that. And I guess maybe we'll bring James in here. I mean, I think most people in the room would probably agree that listed infrastructure is pretty sophisticated and well down the path with ESG. So how does the Future Fund think about the ESG and the sort of sustainability of the asset class?
Yeah, good question. So we tie ESG into our investment process from the first time we look at investment through the full underwriting process. We monitor the ESG issues within our portfolio using various technology platforms, and we engage with our managers to ensure that everyone is focused on the ESG components of the investment that are relevant. That ties sort of more broadly into our valuation framework, which I think that, like just listening to the comments we've discussed so far on premiums and the like for control, I think we have, that's something we often debate at the moment. What is the premium for control versus having liquidity? We did this exercise a couple of weeks ago where we got the infrastructure team together to rank our assets from what we liked the most to what we liked the least most, and we included the listed stuff as well. And so what we did was we looked at all the fundamental characteristics of the different assets that we owned, and we used those, looked at the business case, looked at the ESG. And once we'd done this ranking, what was interesting was that the listed side looked really competitive against the unlisted side when you look just at that pure fundamental metrics. And I think that this is where we debate a lot around the premium from control and how strongly it ties back to whoever underwrites the fundamentals of the business best is going to do the transaction which captures the value, whether it's listed or unlisted. So I think the moral of that story is that we're really sort of trying to evolve that theory around capturing those sort of illiquidity premiums, capturing premiums for control, and trying to focus really on the fundamentals of what are driving these individual businesses.
Excellent, thank you. Maybe with unlisted assets, Ashwin, it's not so straightforward as divesting a stock. You have these assets for a very long time. They're big and they're expensive. So maybe you can just talk through, I guess, how IFM thinks about it, and I guess maybe some of the challenges with working through ESG and the energy transition, and
Yeah, I mean, I guess the concept around it being a fundamental part of the investment screening process is the same. As an active manager or an unlisted manager, it's necessary to then have plans that go above and beyond that. We have to set up and implement those plans, and those plans can range obviously from a decarbonisation plan and targets that align with our sort of in-house targets, and they can range from other elements, whether it's sort of governance issues, whether it's looking at D&I issues at the asset, and that tends to be delivered by sort of the asset management team. So you set those plans and you actually influence the board and management to deliver on those plans. So I guess the screening process is important, part of the business case that you underwrite when you acquire an asset. And then I guess the next level as the active manager, you need to have the skill and the nous to deliver on those ESG sort of targets that you're setting.
And maybe a comment from you, Alex, on the broader landscape. I mean, as an investor, how do you feel that unlisted is going about ESG and the energy transition? I mean, not all managers are doing a great job, which we know well. And that means different things in different sort of jurisdictions. So, yeah, do you feel like CBUS is able to, get the most out of asset managers from the ESG perspective?
Yeah, again, responsible investment it's all part of the investment process. It's a key risk, a major risk that's treated like all other risks. If you don't like the mitigated outcome of your risk assessment, don't do it. Governance is slightly different in my perspective. Governance is more of a hurdle issue. If you don't get the right governance, it's very hard to change that afterwards. There's some structuring you can do around that to support a less than perfect governance arrangement, but it's quite different, in my opinion, to environmental considerations, which can be mitigated in different ways. And you get a trade-off, you know, energy security on one hand, clean energy on the other hand. How's the transition going to be orderly? You know, then to the next questions that go to the heart of value, how long are we going to need these technologies? You know, transmission networks used to be perpetual assets, you know, you'd have them on a 99-year concession, expect that last forever. Questions now about, will the new rollout of transmission still be needed forever? Are we going to have a hydrogen solution? Are we going to go to microgrids? All of those types of things that are definitely impacting our consideration as to what the value of these assets are and therefore what the consideration should be.
Excellent. Well, I thought we might open it up for some questions. I'm sure there's some good ones in there. Maybe some good ones from the audience.
Thank you very much, and I really appreciate all your insights. It's just maybe the other part of ESG is S. Can you talk to social license and how you incorporate or mitigate those kind of risks?
Yeah, I can go first on that one. Interesting comment, Rob. The S has been the forgotten part of it for a while, but it's certainly, particularly with First Nations considerations, come to the prominence that it should have. I'm noticing it a lot on energy assets in general at the moment. Key social issues about where transmission lines are going to go, key social issues about whether they should go above ground, below ground. We're working on a project at the moment that's at the forefront of that with Star of the South, you know, how that transmission is going to work with it. And, you know, I've heard a lot of people speak to or refer to NIMBYism, but I actually have a lot of sympathy for transmission lines going over properties, and read a very interesting article about the different consideration between that was received as compensation for a transmission line as opposed to telco, having a tower on your land and those types of other infrastructure assets that some would say are less invasive, or a wind farm. It's a really interesting conversation with no definitive answer, but certainly, you know, taking into account all material views is very important. It does really delay projects in doing that, particularly the mass build out required for energy transition.
Yeah, I would echo the point on the First Nations engagement. I guess, again, as an active manager, we've got people within our asset management team who are focused on working with each of our assets on their individual First Nation strategies. For example, we own a majority stake in NT Airports up in Northern Territory, obviously, and that's a huge focus for the board and the management team there, working with the local communities and making sure that we are providing opportunities to local Indigenous communities up in NT. The S is being wrapped up as part of the broader responsible investment group within IFM, and they work with each of the asset teams to look at the relevant aspects within S. I guess the other one that we spend a lot of time focused on, given our heritage, is sort of the OH&S side of the S, really working on delivering, I guess, safety outcomes across our assets. We have a large transportation portfolio across both the Australian and global funds. We have the management teams working globally across the assets to drive safety outperformance, learnings across different toll roads, for example, and that's been quite a successful program in being able to protect both customers, employees, and then the broader community. And so that S can translate all the way from things like putting these things called pushing trucks to protect workers on the toll roads, all the way to really working with communities around, I guess, road safety things. And, you know, we own some toll roads in sort of LATAM and Mexico, where it's really around working from an educational perspective with local communities around road safety, wearing seatbelts, you know, how to use the road. So there's quite a variety of things from a manager perspective that we focus on that side as well.
James, if you...
Oh, look, I was just going to say, so sort of more specifically to a listed sort of sense, I guess, this is obviously a very important thing. We look at it internally, we work with our managers to look at it as well. But it's also for us really just choosing, we get the optionality of choosing the best stocks that we want to invest in that represent the best ESG that we want to have exposure to. So I think that gives you that flexibility. Where we do encounter issues with stocks where we own a stock, then our favoured way to tackle that is through engagement. In which case that can be us engaging directly. We have an ESG team as well that does engagement too, and then through our managers as well.
Maybe just one point from me, and Alex brings up Star of the South, and I think that's where we're seeing potential divergence for renewables managers, and really that sort of ability to manage social license risk. It's a key execution risk, and we want our clients to be invested in managers where that is a core competency, and you are starting to see some divergence in how seriously people take it. So.
Hi there, Trent Kosh from First Sentia. I think you've got a lot of listed infrastructure managers in here, and we'll probably all agree that valuations are looking cheap today. I'm just interested to get your thoughts as to how you reconcile the valuations of the two. If you look at unlisted markets where valuations are generally held firm, and you do see a disconnect where maybe valuations come back, does that change your weightings? How does it change your thinking as a asset allocator?
Yeah, I can go first on that one. So look, it's something we pay a lot of attention to. How do we assess it? So we're constantly looking at transactions, we're looking at various indices and comparing them, and we also do that work in our own internal portfolio. Our strategy is to take advantage of those kind of disconnects. So, if we wind back to when COVID hit is a good example, so October 2020, we deployed into listed infrastructure and listed property, and it was, I think, at the time, it was one of the largest transactions that the Future Fund had done in a single hit. So that's what we do, and I think that, if you look at today, I think my view is that the unlisted market is being better at valuing the long-term cash flows and inflation pass-through of the underlying businesses they own, and I think that the listed market is too focused on guessing base rates. So in this instance, I favour the unlisted valuations over the listed in terms of their accuracy.
So we look cheap.
You look cheap.
But you don't get the control.
Again, so coming purely from the unlisted side, I guess just from a valuation perspective, for those who maybe aren't across the unlisted valuation space, we have external valuers who will value the assets, and they will typically do cross-checks against both market transactions and listed comparables as well. Now, there's not always a direct listed comparable for every asset that we own, but that cross-check will look at trading multiples, will look at what the implied betas are for listed assets, and they will then take a view on whether those comparables are the right comparables, and what that means for the overall valuation. So there is a cross-check from an unlisted valuation perspective against what we see in the listed market.
Yeah, similarly, what's been really interesting with the limited, particularly seaports, very limited listed comparables for that. The valuers are now doing a lot broader cross-checks across transport assets more generally. And there's a couple of transport transactions coming up this year in Australia that I think will well support the valuations that we're holding in the unlisted market. So just thinking back over the last 10 years, I would actually say that the unlisted assets, as a very, very broad generalisation, have been on the conservative side to where they've transacted, or similar assets have transacted.
Yeah, we've seen that on our side as well, with the recent exits being, particularly in the transport space, being at premiums to what we were holding those assets at, and that's despite, I guess, a market where you talked about rates. So there's despite a market where rates have been historically high, or higher than the last 15 years. And so I think the market still sees the value in the assets and the inherent, the pass-through of inflation, the fact that these are assets that are essential services, defensive positions, and that's the market's still valuing those, and the values reflect on that in their valuations.
I mean, I think one thing on valuations, it's quite easy to say, oh, well, it's a core asset, unlisted's overpaid, but often they're not core strategies, and we we're trying to allude to that before. If you're taking what is a big core asset and then using it as a platform for strong growth, which does happen across plenty of assets, it is a different paradigm. I mean, Heathrow's going to be quite a good example of where that might be, where there might be a big difference to what private investors are trying to do to public investors. So,
particularly in the telco space, you see those big incumbents that have got copper or even some cable network there that need to transition to fibre. And so it's very hard to compare those because of the strategy being put on top of, what was, for example, a Telstra or, a listed incumbent telco, because of the strategy and the level of capital required and therefore the control that needs to come with it to put that in. So it's quite hard. Find it, the GLI index very broadly, but, a lot of US midstream energy utilities, which they'd be largely underrepresented in CBUS's portfolio. We tend to look now, had a very strong transport holding, but are looking now towards the growth assets, which are not represented as much. Data centres probably been the key example. Difference there, that data centres are well represented on both the public and the private markets. They're very different strategies between the assets.
Yeah, time for one more.
No, thank you very much for the insights. In the last 2 months, we saw a couple of consolidation in the infra fund sector. So we saw Blackstone buying out GIP. We saw Aquila being bought by Commerzbank, and I think a few others. You guys see that as just tactical buyouts, or is there a trend in the industry for more consolidation given interest rates and cost of capital?
It's an interesting question. Infrastructure is obviously a game of scale, but they're, particularly in the GIP situation, such big established managers themselves, and often with a lot of subsidiaries in new sectors as well. Atlas, the GLI manager, is part owned by GIP as well. So it is interesting to see those. I do question where the synergies are coming from. What exactly is the value of having a consolidated entity? I don't particularly have a view, to be honest, about whether that's going to be a trend amongst GPs, but one other trend I have seen is a lot more backing of startup GPs by existing GP funds, for want of a better word, Blue Owl and Dial and those types of funds, Pinnacle, who aggregate and provide the distribution or even the seed capital on top of it. And I expect that trend will continue. It's been very successful.
I guess I'm not sure if I can answer your question around the broader trend, but I guess what the sort of our view, obviously GIP being a key competitor for us, our view on that transaction is net positive. Our broad view is that infrastructure is underrepresented as an asset class in the US, and BlackRock's reach and I guess weight in that market more broadly across a lot of other asset classes will help unlock some of that capital. And I think overall, and I can't comment on the price that they paid and what their views are, but if that upside that they're looking for does play out in terms of the weight of capital looking for a home in infrastructure, whether it's unlisted or listed, that'll just be, I think, a net positive across the sector.
Got no strong views.
I mean, we've seen a lot of it. I think it just shows how difficult it is in private markets to scale a business. And look, there is a lot of competition out there, particularly in the US. I mean, there's a phenomenal amount of activity going on with new GPs. And, I guess maybe some of those private equity managers with the North American style, which typically is a little bit more growth orientated, maybe there's some greater sort of, philosophical alignment. But I mean, capital is important to unlisted managers. You need to have capital still pouring in to be able to, buy and sell assets, and so that's what the big managers will bring to the smaller infrastructure managers is big Rolodexes of clients. So great, fantastic, thank you.
Thank you.